Hey, it's Josh with Swift Home Mortgage. Thanks for watching. I wanted to talk to you today a little bit about a question that I get asked a lot, or questions that people might not know to ask or how to get the answers to. And that main question is, what drives mortgage interest rates? We talk about that a lot. The news talks about it. You see it on advertisements, you see it on Facebook, you see it on billboards, like all kinds of stuff. Rates going up, rates low, act now, lowest they've ever been, historic lows. All of those terms you hear quite a bit when people are referring to mortgage rates. And I just wanted to tell you a little bit about what drives that and what kind of control that you have around it, and the lack of control that you have around it. So the first thing that I'll talk about is inflation. Inflation's been a hot topic lately in the news, and economic leaders and experts are all talking about inflation. So the simple terms is when inflation goes higher, mortgage rates go higher. Inversely, inflation goes lower, mortgage rates go lower. So when we all hear about inflation going up, that's a little bit of a nail biter in our industry because we love low rates. We love to see rates low. Inflation goes up, rates go up. That's something we have to deal with as mortgage professionals and as homeowners and home buyers and people refinancing homes in the future. So that's just a little quick tip about inflation. A second big driver to mortgage rates is economic news. In a good economy, rates tend to be higher. In a bad economy, rates tend to be lower. Good economic news drives rates higher. Lower unemployment, people at work, people that don't need jobs, people that are making great money, rates tend to go up a little bit because things are going well. When things go bad, recession, stock market troubles, unemployment numbers through the roof, rates tend to drop a little bit, which is good for the segment of people who are able to still buy homes and still refi and take advantage of those rates. But low rates sometimes equate to a global, a bigger picture of a worse economy. So it's not always necessarily awesome to see those rates at bottom out, because there's probably the bigger picture being affected there with maybe a little bit tougher economy. Another thing that affects mortgage rates daily, and oftentimes multiple times per day, is the 10-year Treasury yield. So this is something that our secondary markets and our investors and our pricing people look at daily to know where to set interest rates, because that closely monitors the health of the market and what's happening in the market to dictate rates. So simply put, just like inflation, when this 10-year yield goes up, rates follow and go up a little. When it goes down, rates also go down. So that's a nutshell explanation of that, but that's something that you can watch in real time in many different sources and kind of watch what that 10 years is doing and how it affects these rate coupons. Something else more basic that we all learned in high school is simple supply and demand. So what this means is when you have tons of people, everybody and their brother is out trying to buy a home or refinance a home or take advantage of low rates, then lenders have a huge demand for their product, and they can limit the supply and then in turn raise rates to maybe take advantage of all the people out there who are trying to get a lower rate. That's just simple supply and demand. If a lot of people want it done, rates might go up a little bit and cause a little bit higher cost to that. If there's not a lot of volume and there's not a lot of people lining up to get things done, lenders might dig into their margins a little bit, lower some rates to entice people to come in and purchase or refinance their home in order to get volume back up. Simple economics, supply and demand, we are not immune from that. That's kind of a universal basic economic law. All of those things are things that you really have no control over. That's all market conditions, world economy, national economy, local economy, big business, stuff that you really can't tackle and change on your own. Here's a couple things that you can control and then you can be a part of changing to get a lower interest rate. Obviously, the first one is going to be your credit score. Maintaining the best and highest credit score you can is going to yield the best rates that you can get a hold of. Down payment's another thing that you can control that affects your interest rate. If you're trying to get a zero down product or down payment assistance, then your rate's probably going to be a little bit higher because that's a much riskier loan than someone putting 10% down or 20% down of their own money into it. So the more money that you have to put into the loan, typically the better the interest rates are, because that's not as big of a risk for the lender, so you're getting a break on that interest rate. Property type is another one. If you shoot for a single family home, typically those are going to be the best rates that are available compared to a condo or a manufactured home. Those two different properties are a little bit more risky, so they carry some higher rates. So if you shoot for that single family regular stick built home, you're probably going to get a better interest rate than compared to those other two. Occupancy, that's something that means are you going to live in the home? Is it going to be your second home? Are you buying it as an investment home? All three of those different occupancy types have different rates. Obviously, the primary residence, the primary occupancy is going to be the lowest rate. Second home is going to be a little bit higher in some cases, and then in most cases, investment homes are going to be the highest because there's more risk to a lender on an investment home than there is on the house that you're going to be living in. Loan size. We find that a lot of these investors and people doing loans are pricing their lower loans a little bit higher than their higher loans, simply for the fact that those higher loans pay out a higher yield and a higher profit to the investors and everybody down the line in the mortgage bonds that get traded. So if you're trying to get a $50,000 mortgage, that rate's probably going to be higher than if you're getting a $250,000 mortgage. So many times it might be worth not putting as big of a down payment on a house to get a bigger loan size to get a better rate. That sounds counterintuitive, but that's kind of the way the rate sheets are structured and the way things work. Discount points and rate buy down is another way that you can save on interest rate. Basically what you're doing is you're front loading the interest paid and you're paying points up at the beginning of the loan at closing, and you're buying your rate down and making that rate lower over the life of the loan. So there's no set formula as to what 1 point does. If you pay 1 point, you have a $200,000 loan, you pay a point for $2,000. Maybe that lowers your rate a quarter, maybe it lowers it 1/8 of a point. It all depends on how the pricing is structured, but that's one way that you can control what rate that you get. And finally, the biggest thing that you can do to control your own rates is work with a lender who you know has good rates. That's where we come in. We are brokers. We have very thin profit margins that we work on here, and we're able to pass along huge savings to our borrowers and our clients that your big retail lenders or your big internet lenders or banks might not be able to do. There's a lot of overhead that comes along with owning a bank or owning a gigantic retail operation on the internet. We have a lot of that lower overhead here. We don't have as many people to pay. We don't have as big of an operation, so we are able to save that and pass it on down the line. So that's a big consideration to working with somebody local, a local broker, kind of a smaller operation, is that you will save money in the long run. So any questions about any of this, I'd love to talk to you about it. This is kind of what we live and eat and breathe all day. So I'd love to talk to you, 813-606-4255, or visit us online at swifthomemortgage.com. Thanks for watching. Have a good day.